Good afternoon, everyone. It's Monday, the 22nd of April. Welcome to a brand new edition of Market Mondays. My name is Tilan Wickramasinghe. I'm the head of research for Maybank Securities in Singapore. Well, we saw markets overcome with fear over greed last week with a lot of the Middle East escalations happening. And I think this is really the new normal. We've got two major conflicts happening in the Middle East as well as Ukraine, and we've got a Fed that is 1 minute hawkish and 1 minute dovish. So that's introducing a lot of volatility into the markets. Now, times like this is when low beta markets like Southeast Asia actually really come in to the fore. There's a lot of potential winners in markets like this. Now, today we've actually taking a very special look on the Johor-Singapore Special Economic Zone. Many of you have asked us how to play this theme outside the very obvious property names in Malaysia. So that's what we've done, and we're going to have a conversation with Hak Bin and Seng Yao a bit later on. We've also got Husseini, who's just upgraded STARHUB, as well as he's reiterating his buy on Singtel. So let's find out why. We've also got a brand new initiation coming out of Indonesia on their largest bread maker, and we'll talk about that. And then we've got two brand new calls from Nick, the chart guy, as well. So do stay right till the end. Now, let's just do a quick look on the market moves. If you haven't downloaded our newsletter, please do that from the QR code that was, as well as from your trading app. S&P as well as NASDAQ was down, mostly led by the Magnificent Seven last week, mostly from profit taking, we think, given where prices have gone, and particularly given all the uncertainties of last week. Japan also lost out, given where valuations are there as well. Hong Kong as well as China continued to underperform last week, given slow growth, and that actually dragged down the rest of ASEAN as well. Now, let's turn to stocks, as well as let's turn to attention on the Johor-Singapore SEZ. As I said, there's a lot of interest on this. Many of you have asked us about this, and last week I was actually at a Singapore Chinese Chamber of Commerce event on the SEZ, and that was a full house. So earlier last week, I had a conversation with Seng Yao and and Hak Bin, and I'm going to show you that video right now. So just
October 2023, Singapore and Malaysia announced that a special economic zone will be created in Johor. Although comprehensive details of the SEZ will only be officially revealed in late 2024 at the G2G level, Maybank Research has launched a primer on how the SEZ can uplift economic value creation on both sides of the Causeway and where the synergy multipliers can be found. In this video brief, we will be joined by Tilan Wickramasinghe, our Singapore Head of Research, and Dr. Chuang Bin, our Co-Head of Macro Research, to get their insights. Tilan, what are the key success factors for the SEZ in your opinion?
Thanks for having me on the show. So I think when you look across a lot of special economic zones across the world, there are three common factors that kind of ensure success. And the first one is location. The SEZs have to be in the right place. Now, if you look at Singapore and Johor, they're right next to each other. So I think you can tick the location box. But there are two other factors that are even more important. The first is policy. You need to have very clear policy by the governments that are initiating the special economic zone in terms of what sort of tax breaks that they give, what sort of incentives that they give, and so on, so that it is very, very clear what the SEZ stands for. And then finally, smooth logistics. So a large part of why SEZs fail is that there isn't, the logistics component has not been well thought through in terms of the ports, the airports, connectivity, and so on. So I think if you look at the SEZ that Johor and Singapore are planning, I think a lot of these factors are being addressed, or at least there is a will between both sides to address a lot of these things.
Okay, great. Maybe let's turn to Hak Bin right now. Hak Bin, as both Johor and Singapore become more integrated, which sectors will benefit the most in both countries?
Well, there will be many sectors switches to the special economic zone. logistics, energy, manufacturing, tourism, healthcare, education, financial services, business services, and the digital economy. Bear in mind that if the SEZ takes off, I think both Singapore and Malaysia can capitalize on the shift in manufacturing supply chains away from China. Singapore is already Malaysia's #1 source of foreign direct investment last year, and actually Singapore is Iskandar region's #2, second largest foreign investor after China. So one obvious beneficiary is the renewable energy sector. Singapore, as part of its push towards net zero, plans to import about 30% of its electricity supply from renewable sources by 2035. The Singapore government has already set aside a future energy fund with initial fund size of 5 billion. Johor can attract more solar energy projects and export the renewable energy to Singapore. Another related area is data centers. Due to the high and carbon-intensive energy consumption, Singapore imposed a moratorium on new data center builds in 2019. This has been relaxed lately, but remains highly regulated. Johor can capitalize on its abundant energy resource, cheaper electricity, to attract more investments into data centers. And MNCs in Singapore want their data centers to be geographically close to Singapore. A third sector is Johor's retail and tourism sector. A greater cross-border connectivity and shorter travel time will attract more Singaporeans to holiday and shop in Johor, boosting retail, F&B, golf resorts, and hotel. This will lift another sector, which is the property sector. Singapore's property prices is easily more than 4 to 5 times that of Johor. Singapore is also facing an aging population. More Singaporeans want to buy a home and retire in Johor if the government can simplify and relax the rules for a retirement residency, like in my second home scheme. This will also relax space and supply constraints that Singapore faces in managing a growing population. And with more flexible working arrangements after COVID, some might prefer living in Johor given the space and costs, and zoom in for work and travel occasionally to Singapore, to the office only when necessary. And related to this is the healthcare sector. As more Singaporeans want to stretch their dollar, and an aging Singapore will mean more healthcare spending. Almost 1 in 4 Singaporeans will be over 65 years of age by 2030. Singaporeans can already use their MediSave for some Malaysian hospitals with some regulations. MediSave can be used for hospitalizations and day surgeries. The potential opportunities for more healthcare facilities and retirement homes is tremendous. This will reduce the stress and pressure in Singapore's public hospitals, which already faces long waiting times for certain treatment and doctor appointments. There's also currently a shortage of nurses. So Singapore companies in certain sectors like retail and F&B and manufacturing will also benefit if more Malaysians can easily cross over daily to work in Singapore and reduce the labour shortage in certain segments. So I think a Johor-Singapore Special Economic Zone makes a lot of sense for both sides.
Thanks, Hak Bin. Dylan, let's come back to you. We've heard a lot from Hak Bin on the macro side of the world. What are the 5 major investment themes for the SEZ then?
Yeah, sure. So when we actually distill the sector winners that have been talked about, as you say, we have 5 equity themes that we are quite positive about. The first is optimizing hinterland access, and what that means is for both sides, for Johorians to cross over to Singapore and for Singaporeans to cross over to Johor, I think a lot of the friction that is there today, if that goes away, that will have a significant multiplier effect on multiple industries. So I think that's one of the first equity themes that we like. The second is stimulating more North Asia to Southeast Asia supply chain shifts. As you know, with the trade war with China, friendshoring, all these things happening right now, I think there's a lot of opportunities for production facilities to move away from China and into Southeast Asia. And I think this will be a very strong competitive advantage compared to some of the other Southeast Asian countries that are competing, given that you have the policy stability and the Singapore Financial Center, along with access to competitive land and labor. The third is fast-tracking net zero. As Hak Bin said, Singapore has very clear net zero goals that are in place, and I think Johor has access to quite abundant renewable energy as well as transmission capability. So I think that will help Singapore's case in moving to net zero. The fourth is expanding infrastructure as well as property development. I think as more and more people and businesses move to Johor and start expanding, you will have this need for more infrastructure and property. So that will be another theme to play. And then finally, actually broadening the SME economy. So I think if you look at Singapore and Malaysia, more than 97%, 99% of businesses are SMEs, and having this linkage to Johor where costs can be competitive will enable a lot of SMEs out of Singapore to have better margins, and also for Johor companies to have better access to the market in Singapore as well. So that will also provide more multiplier opportunities from the SEZ. So 5 themes: optimizing hinterland, stimulating north-south supply chains, fast-tracking net zero, expanding infrastructure and property, as well as broadening the SME economy.
Okay, great. So Dylan, to bring this all in then, what are your top stock recommendations in this report?
Yeah, so we've got what we call the Maybank Securities, SEZ winning dozen. So we've got 12 stocks, equally weighted for Singapore as well as for Malaysia. Companies that are more near to midterm sort of catalysts, where we see, taking part in the 5 themes that we talked about. So we've got Axis REIT, CIMB, Fraser Centrepoint Trust, Franken, Genting Singapore, ITMAC Systems, OCBC, Sembcorp Industries, Singtel, SolarWest, SP Setia, and Telecom Malaysia. I know, some of the more obvious names like property developers and so on are not in this list, and partly this is deliberate to kind of bring focus to the second liners or the third liners, while the first line sort of property development stocks have already had a very, very strong run. We think investors should be looking at the second liners and the third liners now to really fully benefit from this SEZ theme.
Thank you very much, Dylan, and also thank you, Hakbin, for your contributions earlier too. Well, that concludes our video presentation. For clients, you can download the report from the Maybank Trade app. Either that, or you can contact your sales representative for a copy of the report. Thank you very much.
Okay, I hope that was helpful. So please do download this report. You can download it directly from the newsletter today. We did cover a lot of stocks as well as a lot of themes, so do take your time to read the report and get to know the key stocks to play. Now let's turn to telcos, and we got Hussaini, who's taken a magnifying glass to the Singapore telcos. Now, some might argue saying that this is kind of a boring sector, but he thinks there is a lot of money-making opportunities right here. So, Hussaini, let's start with STARHUB. You've upgraded the stock to a buy. This has been rated a hold for a very long time, and most of the street, most investors have really not been paying a lot of attention to this stock. So, why now, and what has changed your view?
Yeah, sure. Thanks, Dylan, for having me. 2 key factors driving our buy call on STARHUB. First, company is at the tail end of its DARE+ investment cycle of last 3 years. While the investments, this DARE+ investments were upfront, positive outcome of debt should be visible from 2025 onwards. And this will be in the form of 2 to 3 percentage points lower capex to sales, as well as lower operating costs. Now, lower operating costs will come from elimination of legacy systems and platforms, as company has already installed newer systems as part of DARE+ initiative. Falling capex and opex translates to an attractive 10% earnings growth CAGR on our estimates. Second factor driving our buy call is company's dividend yield of 6%, which is mostly backed by its free cash flow generation. With DARE+ coming to an end, we expect free cash flow per share to increase at 29% CAGR. As such, we see potential for DPS to also grow at a faster clip. Maybe the last point I would say is that we also see potential for consolidation in Singapore, mobile consolidation, which also remains a catalyst for STARHUB in our view.
Got it. So actually, I want to talk about consolidation. I mean, there's four operators in Singapore. It's probably one of the most unconsolidated markets when you look at some of the other ASEAN markets here. So what are your views in terms of consolidation for the Singapore market going forward, and why hasn't it happened so far?
Okay, so in fact, most of the Asian markets have consolidated in the last 3-4 years, not just ASEAN. So this includes India, Indonesia, Thailand, Malaysia, Australia, Taiwan. And now most of the markets is reduced to 2 to 3 players. Now in that light, Singapore with 4 mobile operators and with just 5 million population remains highly crowded and as such ripe for consolidation. To the second part of the question, see the new operator in Singapore, i.e. Simba, only started commercial services in 2020. So it was expected that it will take a while before consolidation. Now with mobile prices already corrected 30% in the last 3 to 4 years, we think that the market is now ripe for consolidation. Based on our discussion with the telcos, it appears that regulator IMDA is also open to consolidation. We see STARHUB and M1 as a potential consolidation candidate. They already share 5G network and as such see them as a logical partners. Based on our analysis, a potential STARHUB M1 merger could help in 23 to 43% lift in STARHUB earnings.
Okay, that's something to watch out for. Now let's turn our attention to Singtel. It's had a streak of bad news recently with the Optus outage, and then there was some hope from the market that they will divest Optus, and then management came out to say that they wouldn't. So at this stage, why are you reiterating the buy call on this stock?
Yes, see, Optus was the main pain point for Singtel, no question about it, in the last 1 to 2 years, and that is linked to, as you pointed out, network outage as well as cyber attack. But beside that, I also see that Optus was also sucking away 28% of Singtel's operating cash flows and associate dividends in the last 10 years, and as such lowering Singtel's own ability to pay dividends as such. Now with recent setbacks at Optus, we think Singtel management is taking a hard look at Optus investments. We see Singtel is moving from a we see Optus is moving from a full service carrier by rationalizing content, smart home initiatives, as well as enterprise services. We also expect capex levels to come down as well for Optus. Now on the second part of your question, yes, Singtel denied specific market news on Optus, but we don't think company has declined potential Optus rejig. Management actions of the last 2 to 3 years also suggest that it has moved out of businesses which were low yielding or loss making, and Optus falls exactly in that category. Now in our view, the potential Optus options includes network sharing with TPG, partial stake divestments, or divestments in Optus subsidiaries like enterprises. These actions will help to improve free cash flow and ROIC in our view.
Right. So never say never with Optus. And then finally, and very quickly, Hussaini, you have been speaking to quite a few institutional investors over the past week or so. Any major highlights that you can share with us?
Yeah, sure. So on Singtel, we see investors are warming up. They do see the recent correction has unearthed deep value, especially the recent Bharti share price increases, which is not reflected into the Singtel stock. So for perspective, Singtel owns 29% stake in Bharti, and that stake itself represents 93% of Singtel's market cap. Now, this suggests deep value and an arbitrage opportunity in our view. Key investor concerns on the dividend on Singtel includes dividends. Investors are expecting special dividends. In my view, Singtel will pay dividend at the higher end of the payout guidance and may guide it to sustain that into the future years as well, rather than paying special. So I don't expect company to pay specials, but to pay at the higher end of the guidance. On StarHub, investors do agree with our strong earnings and dividends growth expectations. However, they remain skeptical on the StarHub M1 merger. They think that Keppel, which owns M1, may not be willing to divest M1, and as such, don't see market consolidation on the horizon.
Got it. Thanks. That's very good color, Hosseini. And that's all the time we have for telco. So thank you for joining us. Now,
Thanks, Alan.
Now let's turn to Indonesia, where Jocelyn Santoso, she's initiated on Nippon INDOSARI or ROTI, as the ticker goes. This is Indonesia's largest bread producer with around 13% market share. We see this company as a proxy to the whole Indonesian consumer sector. And she's seeing multiple catalysts for this stock. She's got a buy on this stock with a target price of 1,600 rupiah, which is about a 40% upside from current prices. So in terms of the catalysts, she's expecting overall sales to grow about 13% this year after contracting 3% last year. And also she's seeing more and more consumers shifting to modern retail. And ROTI actually has about a 98% penetration in modern retail in Indonesia. So with this switch happening, they will be one of the key beneficiaries. Plus, Indonesia is growing. The population is growing. Dietary habits are changing as personal incomes rise. So that will all drive organic growth for bread consumption. And again, ROTI will be a beneficiary. All of this will support free cash flow generation for this company, which is very good for dividends. In fact, we're forecasting around 6.4% dividend yield for this year, which is about significantly higher than the 2.5% we're expecting for the overall Indonesian consumer sector. So do take a look at her report in our newsletter today. And then finally, let's quickly run through technicals. Nick, the chart guy, can't join us today. I know he's a favorite, but so I'm going to be subbing for him. So he's got two stocks today, ST Engineering, where he's calling for a technical buy. Last week's Morningstar pattern signals a continuation of the long-term uptrend for this stock. And then we also have Food Empire, where he's calling a technical sell. The next chart, last week's lower breakout could fuel more downside correction. Do take a look at the newsletter for a much more deeper explanation. Let's quickly have a look at upcoming events as well as dates. Quite a lot of results coming through, particularly from the REITs. CapitaLand Ascendas on the 22nd, that's today. Keppel REIT tomorrow. We've got CapitaLand Ascot REIT on the 24th of April, and we've got iFast on the 25th of April. In terms of events, we've got Invest Malaysia, China happening on the 23rd of April. There's also, for those interested in Indonesian banks, we've got event happening on the 24th of April, and the Thai telco sector to kind of get a balance between Singapore and Thailand. You can dial in for that on the 25th. Please do speak to your salesperson for invitations and access to these events. With that, unfortunately, we've run out of time. Thank you so much for joining us this week. We really do appreciate your support, and you turning up every week helps us put on this show. So thank you for doing that. And we'll see you next Monday. Have a profitable trading week.